All right, so you want the inside scoop on Elevance Health's latest earnings call. Well, you've come to the right place. We've gone through all those numbers, all the financial jargon, to bring you the key takeaways you really need to know.
What I find really fascinating here is how Elevance is really juggling so much right now. You've got those membership shifts, the cost pressures, and then, of course, the big changes in how people actually want their healthcare these days.
Yeah, juggling is right. But they seem to be doing it pretty well. I mean, they hit their earnings per share target for Q4, $3.84. And that's even with all those headwinds you just mentioned.
Right. Meeting those expectations is always good, especially in this environment. And overall membership did dip just a little, but there's some nuance there.
Okay, so let's unpack that. What's the story with the membership numbers?
Well, they actually saw some growth in some key areas too, like employer group plans and also ACA marketplace offerings. So it's not like a simple story of just decline across the board.
So they're adapting
Mm.
to the changes in the market, finding those pockets of growth. That's pretty smart.
Yeah, exactly. It shows they're not just sitting back and reacting. They're being strategic, positioning themselves for where the market's headed.
Okay, so that's membership. What about their financials? What were the biggest wins and challenges they face this quarter?
So their Carelon segment had a really good year, like exceeded their revenue growth targets. And that's something to keep an eye on because it could be a game changer for the entire industry.
We'll definitely have to dive deeper into Carelon later on, for sure. But first, let's talk about Medicaid. It seems like that's where they had some of the biggest hurdles.
For sure. They did call out those high cost trends in Medicaid,
Yeah.
particularly for behavioral health and also inpatient services.
I'm guessing those redeterminations had a big part in that, with states reevaluating who's eligible for Medicaid.
Oh, absolutely. The mix of people in Medicaid shifted after the redeterminations, which seems to have driven up costs.
So it's not just that they lost members, but the ones who stayed on might just have higher healthcare needs, which is a tough situation.
It is. But Elevance is working on it. They're working with those states to adjust rates, and they're thinking Medicaid margins will get better, later in 2025.
Fingers crossed on that one because that turnaround is going to be big for their bottom line.
Yeah.
Okay, let's switch over to Medicare Advantage. How did they do there?
This is where things get really interesting. Elevance saw strong retention in Medicare Advantage, and it beat expectations.
Really? Weren't some analysts saying they expected lower growth there? So what's behind that?
Well, they're saying they expect about 7 to 9% growth in their Medicare Advantage membership for 2025, but they're not relying on new sales for that growth.
So they're really focused on keeping their existing members happy.
Right. Which is smart, considering all the changes in Medicare Advantage lately, especially with those funding cuts over the past couple of years.
That's a good point. Speaking of happy customers, how about their commercial business? How did that perform this quarter?
Well, they actually highlighted some pretty big wins, especially with their integrated medical and pharmacy offerings. They brought in 18 new national accounts for 2025.
18, wow, that's impressive. So employers are really buying into this whole one-stop shop for their health benefits.
It seems that way. And some of these new clients even chose Elevance for both medical and e-pharmacy benefits, which is a pretty big vote of confidence. And they also had record retention in their existing national accounts business, too.
Okay, so they're not just getting new clients, they're keeping the old ones happy, too. That's definitely a good sign for the future. But let's circle back to Carelon for a minute. You said earlier it could be a real game changer. Why is that?
So Carelon is their health services segment, and they saw really incredible growth this year. They're expanding what they call their risk arrangements internally and winning new clients externally.
So they're not just paying for healthcare anymore, they're actually getting involved in delivering it.
Right. It's like going from being the insurer to shaping how healthcare is actually delivered to people.
I see. That's a huge shift. What's driving this growth?
Well, strategic acquisitions are a big part of it. Like they bought CareBridge, which is a home health provider. They're building out their offerings, especially in areas like home health, which, aligns with this whole health strategy.
Whole health. It's a real buzzword we hear a lot these days. Is that where the whole industry's headed?
It really seems that way. It's about looking at everything, not just physical health, but also mental and social well-being. And with the growth of Carelon, it seems like Elevance is really betting big on this trend.
Okay, so they're growing their membership strategically, they're expanding their services, and adapting to this whole health trend. What does all of that mean for their bottom line? How do they actually perform financially?
Well, they bought back $2.9 billion of their own shares last year, which actually beat their initial projections. And they're planning to spend another $2.3 billion on buybacks this year.
Share buybacks are always a good sign.
Yeah.
Anything else for investors to be excited about?
They also announced a 5% increase in their quarterly dividend, which makes this their 14th year in a row increasing their dividend.
Wow. 14 years straight. That's a pretty solid track record of giving back to their shareholders. So we've talked about a lot: membership trends, financial performance, and those key growth areas. What are your big takeaways from this earnings call so far?
I think overall, Elevance is doing a good job navigating a really complex environment. They're adapting to all those Medicaid changes, they're taking advantage of the growth in Medicare Advantage, and making some strategic investments to get ready for the future, especially with Carelon.
It's interesting to see how they're balancing all these priorities. They're not afraid to make big moves, like diving into new markets and acquiring companies to build out their services.
They're not just reacting to the market, they're really trying to shape it. And that's essential in this healthcare landscape that's constantly changing.
Now, all this talk of growth and innovation has got me thinking, what if?
Uh-oh. What are you thinking?
It's the thought experiment. Totally hypothetical, of course. What if Elevance's bet on Carelon really pays off? Like, what if they totally nail that Medicaid turnaround and ADPL on? They become a real force in this whole health space.
Okay, I'm listening. Go on.
Think of the potential. Their stock could just explode. Maybe we should look at, like, a call option with a strike price right above their current guidance. Risky, definitely. But you know what they say? Fortune favors the bold right.
Whoa, hold on there. Let's not get too far ahead of ourselves. Remember, we are not giving financial advice here.
Of course, of course. Just a fun what-if scenario for our listeners. You should always do your own research before making any investment decisions. Always solid advice, but it is kind of fun to think about,
Absolutely. That's what makes the market so exciting.
Welcome back. So we just explored some of Elevance Health's strategic moves, their successes in Medicare Advantage, and those commercial markets. And of course, that really intriguing growth they have going on in their Carelon Health Services segment. And we floated a maybe slightly crazy trade idea, too. That was just hypothetical. Yeah. Always do your own research before making any investment decisions.
Wise words. But now let's really get down to the nitty-gritty and dissect Elevance's financial performance, like in detail. What's their guidance telling us about what they expect for 2025?
All right, let's have it. What were the big numbers this quarter?
Well, for 2024, they brought in $175.2 billion in operating revenue, a solid 3% increase compared to the year before.
That's impressive considering all the challenges they've had to deal with. What fueled that growth?
A couple of things, actually. For one, they had premium rate adjustments that were reflecting higher cost trends that played a part. And also, they've got those expanding customer relationships in their Carelon businesses.
Yeah.
And we can't forget the strategic acquisitions they made in pharmacy services and home health. Those definitely helped boost revenue and enhance those integrated offerings of theirs.
So those acquisitions, they're really going all in on that strategy. But how about profitability? How are their margins looking?
So for Q4, their consolidated benefit expense ratio came in at 92.4%, which gave them a full year ratio of 88.5%.
Right in line with what they're expecting.
Exactly. So they hit their margin targets. But, they did mention those cost trends, especially within the Medicaid population. Those are still pretty high.
Yeah, that Medicaid situation is still hanging around. But Elevance said they're working closely with state partners to try and get those rates adjusted to actually reflect the real cost of care these days. They seem optimistic about improving those Medicaid margins as we go through 2025. Let's hope they're right about that, because that turnaround is going to be key for their bottom line. Okay, shifting gears a bit, how did they do when it comes to controlling those operating expenses?
Well, actually pretty good. Elevance Health had an adjusted operating expense ratio of 9.9% for Q4 and 10.6% for the entire year, which is an improvement of 170 basis points and 70 basis points year over year.
Wait, hold on. Finance hat coming on here.
Yeah.
Remind me again why a lower operating expense ratio is a good thing?
Sure. Basically, it means they're becoming more efficient. So for every dollar they bring in, they're spending less on stuff like administrative costs, overhead, all that, which means more profit.
Right. Okay. That makes sense. So growing revenue, managing those expenses, that's how you win. What does all this mean for their outlook? What are they projecting for 2025?
Well, they're looking at continued growth across the board. For instance, they expect their total Medicare membership to be somewhere between 45.8 million and 46.6 million by the end of next year.
That's a pretty decent range. Where's that growth going to come from?
Well, Commercial fee-based membership, for
Yeah.
one, and also ACA exchange plans. And then, of course, there's Medicare Advantage. They're thinking membership there will hit somewhere between 2.2 million and 2.25 million.
So a good mix of organic growth and then expanding into those new markets.
Yeah.
Sounds like a solid approach. Now the big question, overall revenue projections. Are they expecting this growth to keep going?
Their expectation is for operating revenue to grow in the high single to low double-digit % range. And keep in mind that this also includes those strategic acquisitions like CareBridge.
They're projecting double-digit revenue growth. That's pretty impressive. But revenue is only part of the picture. What are they expecting in terms of, well, profitability, margins for 2025?
They're projecting their consolidated medical loss ratio to be around 89.1%, plus or minus 50 basis points. So that's about a 60 basis point jump at the midpoint compared to 2024.
Little uptick there. Why is that?
They're factoring in those cost trends we talked about earlier, the ones that are still a little high, particularly in Medicaid, and also the impact of those recent acquisitions and adjustments they had to make for the Medicare Part D benefit redesign changes. Those play a part too.
So they're being smart about it and considering those potential cost pressures. What about their adjusted operating expense ratio? Are they thinking they can keep up those efficiency improvements?
Yeah, their projection is 10.4%. Again, plus or minus 50 basis points. So yeah, a small improvement year over year as they continue to try and improve their cost structure.
Controlling costs while still putting money into those future growth opportunities. I like it. Seems like a really well-balanced approach. Now you've got a good eye for this stuff. Looking beyond just the numbers here, what's your impression of Elevance's overall financial health, and what about their outlook for the future?
Well, it seems like they're really focused on delivering sustainable value over the long term. They're realistic about those near-term challenges, but they seem pretty confident that they can execute on their strategic priorities and hit their financial targets. I mean, they're investing in diversifying their business model and expanding Carelon's capabilities. That says a lot about how committed they are to shaping the future of healthcare.
Like they're saying, hey, we're not just an insurance company anymore. We're a full-on healthcare solutions provider.
Exactly. And having that broader vision could really set them apart in the healthcare world, which, as we know, is constantly changing.
Okay, so we've gone through their financials. We've looked at their guidance. We've even talked about their strategic investments. Is there anything else investors should keep in mind as we head into 2025? What are some of the key things to watch for?
I think there are a couple of things to really keep an eye on. Number one, how much progress they make with turning around those Medicaid margins. That's going to be big.
Yeah, they're really counting on that second half improvement to boost their bottom line.
For sure. And number two, how Carelon continues to grow and perform. That's going to be a strong signal about their long-term success.
It really feels like Carelon is their big play here. If it can keep exceeding those expectations, it could make Elevance the leader in this whole new era of healthcare we're moving into.
Exactly. It'll be really interesting to see how they use Carelon to push those boundaries and really deliver value to both their members and their shareholders.
Okay, we've broken down their financials, looked closely at their guidance, and we've talked about the potential of Carelon. What's up next on our deep dive?
Well, next we're going to dig into some of the key questions and insights that came out during the Q&A part of Elevance's earnings call. That's where you can really get those little nuggets of information as analysts press for details and get some more clarity.
I love a good Q&A. Let's see what the analysts were able to uncover. Okay, so we've talked about Elevance Health's performance, their projections for the future, and now it's time for the juicy part, the Q&A, where the analysts get to really grill those executives. So what were some of the hot topics that came up?
Well, one thing the analysts were all over was Elevance's Medicare Advantage enrollment. Some of them were actually kind of surprised they beat those growth expectations, especially after all that back and forth we had with the CMS data earlier this year.
Yeah, that was a bit of a wild ride for a while there. What did Elevance have to say about that strong performance?
They made it clear that the 7 to 9% growth they're projecting includes a big chunk from Group Medicare Advantage. Specifically, a large account they were able to convert from their commercial business.
So it's not just individual MA driving that growth. They're using their existing relationships to get a bigger foothold in that MA market. Pretty clever.
It is. And then for their individual MA business, they're really focused on keeping those retention numbers high and giving their existing members good value instead of just chasing new sales all the time.
Makes sense. Especially with all the funding cuts MA has seen lately. Keep those members happy, and they're not going to switch plans.
Yep.
But speaking of all those regulatory changes, what about the impact of that Part D redesign on Elevance's medical loss ratio? That was a pretty big deal last year.
Oh, yeah, the analysts were definitely asking about that. Elevance admitted that those changes, especially that increased direct subsidy, did have something to do with that small increase in their projected MLR for 2025.
But it sounds like there were no big surprises there.
Yeah.
They seem to be staying one step ahead when it comes to those regulatory changes. Were there any other burning questions from the analysts? Anything else they were really digging into?
They were really interested in Elevance's acquisition strategy, especially after they pulled out of that Blue Cross of Louisiana deal. That was a pretty big one, so the analysts were curious about what they're planning to do next.
Yeah, I bet. Are they still looking to buy up companies, or are they going to be more careful now? What did they say?
Well, they didn't give too much away, as you might expect, no specific targets or anything. But they did say that they're still committed to building up Carelon's capabilities.
Makes sense. Carelon seems to be their big bet for the future. They're putting a lot of eggs in that basket.
Exactly. And they're looking for acquisitions that really fit in with their whole health approach. Things like specialty care, pharmacy services, and tech solutions that make things better for the members.
So it sounds like we can expect more acquisitions from Elevance in the future. They're not done yet.
Nope, not by a long shot. They're really set on building that whole health system. It'll be interesting to see how they make that happen.
So we've covered a lot of ground here. Analyzed Elevance's performance, their projections for the future, and even got into the details of that Q&A session. Any final thoughts before we sign off?
I think overall, Elevance is in a good spot. They're handling the market challenges, taking advantage of opportunities for growth, and making some smart investments to get ready for what's coming next in healthcare. They're a company that's not afraid of change, they've got a clear vision, and it's going to be exciting to see how they keep evolving over the next few years.
Well said. And that's a wrap for our deep dive into Elevance Health's earnings call. Thanks for joining us, and don't forget to subscribe so you don't miss our next deep dive into the world of business and finance. See you next time.